A beautiful Saturday morning in Seattle, Washington, and not a Sunday, but a Saturday. Mr. Patrick Doherty, welcome. Let's get into it in a minute. How are you feeling today?
Oh, feeling awesome, man. It's really good to be back on the show. It's a glorious Saturday morning here in sunny Southern California. It's going to be
Yes.
nice and warm today. And yeah, I'm looking forward to a great show and a great weekend chilling.
Yeah, for sure. We do the Bet Out of That show on Sundays at 8:15 a.m. weekly. But this week I have a business trip for the week in Florida. I'm flying direct from Seattle to Orlando, Florida. So I would be in Melbourne, Florida for this week. And so rather than cancel the show, we decided to do it one day earlier. So it's a little different for us to do it on a Saturday versus a Sunday, but it's all good. Mr. Patrick Doherty, we are going to talk about stocks today. We're going to stay on that
Yes.
same theme, and we are going to talk about how do you know you have a growth stock. And so let's get into that. And then lastly, I know we're going to pivot in the end to show when do you get in a growth stock. So once you select a growth stock and all of that, then you got to figure out, okay, when is a good entry point. So without further ado, Mr. Doherty, take us away.
Okay, so what's the difference between a growth stock and a stock that is not a growth stock? Well, a growth stock is going to have outsized revenue and earnings over the years, and then ultimately that gets reflected in the stock prices, and it will usually perform its key benchmarks such as the 50-day moving average and the 200-day moving average over time. And let me present a graphical representation of this. So let me share my screen here. So as the screen is counting down, okay, looks like I'm ready to share the screen now.
Yeah, it's coming up. That beautiful new iPad you have.
Yes. Yeah, highly recommended. But anyways,
yeah.
Let me give an example of a growth stock. So as I was saying, a growth stock will present the graphical representation of beating major indicators such as the 200-day moving average here, and this is like the 20-day moving average here. So
what stock are we looking at here?
The stock that we're looking at is Applied Materials, or AMAT, on the NASDAQ. And as you can see from the beginning of this 5-year period, that the stock has gone from about $30 a share all the way up to about $150. So we're talking about 500 times your money in a period of just 5 years. If that's not a growth stock, I don't know what is.
Yeah, can you pull it up a little bit so you can see the bottom, so you can actually see the
Yeah,
date?
I'm sorry. This graphic.
Yeah, there we go. That's a little better.
As well, so okay, yeah, there we go. My apologies to the audience there.
Yeah, no problem.
So anyway, so this is starting from late 2016 all the way to where we are right now. And again, we're looking at around between $30 to $20 a share, $20 to $30 a share. And right now, over 5 years, it's $136 a share. Now, these are, of course, the Bollinger Band 2%, 2 standard deviations away. But anyways, as you see, it's well above this 200-day moving average. So, and it's been consistently this way pretty much over this 5-year period.
Hey, Patrick, just not to interrupt you, let's take the Bollinger Bands out until we get to the end so that we do not muddy the chart.
Okay.
So can you go up to the top and can you click on studies and then just X out Bollinger Bands. We can add it at
Yep.
the end so
Okay.
we can
All right.
keep
So
it
my
cleaner.
apology.
Yeah, we'll keep it cleaner to the end. There we go. So you can
Yeah.
see it
Yeah.
better.
So that's probably easier to understand.
Yes,
Okay.
sir.
There we go.
Continue,
All
please,
right.
sir.
Okay. So let me take a look at a stock that does not have such high growth.
Let's go back for a second before we go there.
Go back?
Yeah,
Okay.
yeah. Because I was interrupting you a bit. Can you pull it back up, please, sir, so that we can see the bottom of the chart and all of that and see the dates? Can you pull it up a little more, please?
Yes.
There we go. And pull it down a little bit so we can see where we are today. Perfect.
Okay.
Perfect. So, just looking at Applied Materials here and looking at the trajectory of Applied Materials over a 5-year period, one can see that $65 line, that red line, or what color is that? Black or red? What color is that? Black? What color is that?
This line here.
Yeah, that 200 exponential.
Yeah, that's kind of like the dark red.
Yeah, the exponential 200-day moving average. So you can see, looking at the exponential 200-day moving average, just look at how the stock Applied Material consistently stays above it. So it may breach it for very short periods, but for the most part, it's staying above that 200 moving day average. Patrick, I just wanted to reiterate that to the audience just in case they missed that when I kept interrupting you. That's the whole point here. The whole point is having an exponential 200-day moving average plotted and showing the stock of your choice, in this case, Applied Materials, showing that stock consistently above the 200-day moving average. Now, Patrick, we did not explain what is an exponential 200-day average. What is that? How is that calculated? Can we explain that before we move on?
Yeah, so essentially you're taking the average of stock prices over the last 200 days. And what you're doing is just smoothing it out. Hence, any discrepancies that will kind of distort the graphics of the 200-day moving average. The 200-day simple moving average would be more volatile, and it may not be the true representation or best average to look at. Whereas the 200-day moving average, again, takes a look at the average 200 trading of the 200 days and it smooths out the outliers so that it's easier to chart and more reliable.
Yeah, and the way that 200-day moving average is calculated is looking at today's date and going back 200 days, the closing price of Applied Materials each day for the last 200 days, and then dividing it by 200 and plotting on a chart that particular day. So Applied Materials is a stock. For those who are curious what it is a stock. It's not an ETF. It is a company that builds, isn't it? A company that builds chips, tools for chips.
What it is, it's a company. It's considered a semiconductor stock, and it's in the SMA ETF, which is a semiconductor index or semiconductor ETF. So essentially, they provide the equipment, chip equipment maker. So they provide, I guess you could say it's an infrastructure stock for chips.
Yeah.
So it's in making the processor of chips. They provide the equipment.
Applied Materials is a company, and we're looking at the stock performance for that company. So back to the exponential 200-day moving average. So when you see that line plotted and you see that $65.08 there as of today, as of Friday, because the market is only open Monday through Friday, you're looking at the price of Applied Materials over the last 200 days, the closing price, and then divided by 200 because you did 200 different days. And then the day previous to that is the same process. So you're looking at a plotted curve of 200 days of past closing prices divided by 200 plotted on a line to show a trajectory. And if your stock price consistently is above that 200-day moving average, then that shows that over a long term, your stock is a growth stock. It is growing. So when it dips and falls, you should not panic. You should actually buy more because you're getting that stock on sale. And you know, because of the 200-day moving average, that the trajectory is up. And so you would expect to get more profits because you're buying the stock at a cheaper price. So that's kind of the theory behind it. So I just wanted to make sure at that point, Patrick, did not go over anyone's head.
Yes. Yeah. And that's what the 20-day moving average is used for. It's to gauge as to see how the stock's performing. And if it drops below this 200-day moving average, generally speaking, it's a good time to buy, provided that, of course, the fundamentals remain the same, of course.
Yep, and provided it's a growth stock. Now, if the stock is consistently below that line, that is not a growth stock. That's a stock that's either trading sideways or falling over time, and that's not good. So, Patrick, without further ado, let's move forward. I think we kind of got that point made. So,
okay. So I'm going to bring up a stock. I'm going to talk about General Electric. And let me remove the Bollinger Band here. So this is a company whose stock has been underperforming its 200-day moving average for most of the time. Here we are again in June 2021. This is a 5-year moving average. So pretty much ever since July 17th, this stock has consistently underperformed its 200-day moving average. And why is that so? Because the fundamentals have not been strong for this company. This is a company that's had to restructure many times and sell off many divisions because of underperformance of these divisions. And again, this is being reflected in the stock, and the stock and prices are very, very efficient, meaning that they will encapsulate all of the fundamental data that's out there in the market very efficiently. And here you can see that this stock is underperformed.
And so we're looking at it at the top. We're using barchart.com, by the way. If you were to go up, you can see the current stock price. So let's move this up a little bit, Patrick. So we can see, move up, please, where you can see the stock price above. Yeah, keep going, sir, keep going. Yes, right there. So you can see General Electric right there, where it closed at on Friday. And if we just showed the chart, right, 5 years back. And look, 5 years back, what was the price of this stock? Right there.
This price was about roughly $33 or so, between 32 and 34, roughly.
So 5 years ago, you would have lost a lot of money because, hey, look at it where it's trading today.
So you're talking about $1,000 invested then would be equal to $333 or so invested now.
Yeah, and then that 200-day moving average really shows you, right? So if you were looking at the 200-day moving average some 2017, you would have seen that this particular stock, GE, broke the 200-day moving average trend line. And now GE, you would say, okay, it broke the 200-day moving average. What should I do? Is it going to pop back up and this is a good buying opportunity, or is it going to stay below the 200-day moving average, meaning let's stay away from this stock? This stock is in peril. In this case, in GE, it was in somewhat of a peril, but go ahead, Patrick.
Well, if it dips below the 200-day moving average, then you want to understand why it's doing so. Is it because of the general market, or is there something specific about this company that's unhealthy? And again,
That's looking at the fundamentals. The fundamentals will
we're
help.
looking at the fundamentals,
Yeah, that
and
would help paint that picture, wouldn't it, to tie it in?
yeah,
But go ahead. I
and
interrupted.
as I was saying before, General Electric's business divisions have been underperforming in against its competitors, and they've had to sell many units, and the company has had to restructure many times. So it's been an ugly one. This is an ugly duckling here.
But
And
look at as of recent, and I see a question from Tony Johnson. We'll come back, Tony, to that question. I'm going to leave that up. As a matter of fact, I'll come back to it. But Patrick, let's look at 1 year. Let's look at the 1 year chart
okay,
for
oops.
GE. So let's go up to the top and let's click on 1 year. Now, if you go down, now you will see that wow, GE crossed the 200-day, the exponential 200-day moving average line. So
Yes,
GE on a long term, and that's what the 200 moving day average does. Long term is showing a trajectory that is moving up. So it's no longer in a downtrend. It's on an uptrend for long term growth. So what could have happened here that made this company turn around? What are some of the scenarios we could think of, Patrick?
well, likely they could have had a new management shakeup, so maybe a new CEO
Yep.
came in
Yep.
with a bold new vision.
Yep.
They've the company may have streamlined a lot of accesses that the company had, like a lot of redundancies. It's become more efficient.
Yep.
Maybe the company has decided to focus on a few products that it does really well, as opposed to being stuck in the middle,
Yep.
being being the jack of all trades. And that's a disaster. That's a recipe for disaster, by the way. If you're not really good at any one thing, but you're trying to be good at so many other things, and the competition will just eat you up alive. And maybe this is what the General Electric has decided to do, is maybe focus on a few products and services that it does really well with.
Yeah, and so that's the point. Yeah, new CEO, new vision,
Yes,
streamlining. So then
yes.
that's the technical analysis tells you, one part of the story. What you were just describing there is the fundamental analysis. That's the other side of the story. And so
However,
go ahead, Patrick.
as I was saying, stock prices really um, reflect the fundamentals of a stock. Again,
Yeah.
going back to the efficient market hypothesis, which suggests that technical analysis can pretty much explain the whole picture.
Okay, gotcha. So let's address Tony Johnson question, and that is AMAT a good buy when it's that high above the moving average? And I would say it's a good buy long term. That's what that's saying. That's saying really bullish long term. But when to get in, that's a different story. And we'll get to that shortly, Tony. So
Mm-hmm.
if you hold tight, you'll see how we
Yeah.
get there. But yeah, if it's that far above, it's definitely very bullish and a good long term buy. Short term, when you get in, we'll talk about that in a moment. But continue, Patrick.
So anyway, so this is an example of a company that generally has not been a growth stock, and it's a company that's been around for a very long time. So generally, the older the company is, the chances are that's not a growth stock. However, maybe because it's being restructured, it may become a growth stock. Time will tell.
Okay.
But anyways, I want to go to another stock that is not a growth stock, but it's not necessarily a bad company, and that's AT&T here. Let me get to the chart. chart here, and we'll go to 5 year. So this is a stock that has pretty much moved in an undulating fashion about the 200-day moving average. Unfortunately, if you're looking at capital appreciation, back in 2016, we were looking at a price of about $44 a share versus $29 as it is right now. However, this stock is what I would consider a dividend king or dividend aristocrat, because if you look at the dividend payout and the dividend statistics, you'll see. Give me 1 second.
Can you X that box there, Patrick, that popped up?
Yeah.
Pop up.
Yeah.
Thank you, sir. Oh, it's not going away. It says skip. Wow, you got something going on there.
Skip ahead. Okay, give me 1 second.
Oh man, it looks like
I don't know what's going on here.
Oh man, it looks like you got something going there. But go ahead. All right, it disappeared.
Yeah, that's what I was trying to do. Get to see more. Anyways, the annual dividend yield.
Can you blow that up for cell phones, please, Patrick? Can you pinch? Yeah, thank you.
So the annual dividend yield is around 7%. And it's always been a strong stock for dividends. And it's relatively been consistent at 52 cents a share.
Yeah, look at
so
the
it's a high yielding dividend stock.
Yeah, look at the payout there. It's quarterly, right? So every quarter. Is that quarterly dividend payout there?
That's a quarterly dividend.
So on the so you can see going back to July 9th, 19 and October 19, 2019, you can see quarterly. That's what they're paying out and as a dividend per share, right?
Yeah. So if you have 100 shares, you're getting $51 every quarter, and every year you're getting approximately, $200 to $210 a share, $210 as dividend income per 100 shares.
That's not bad, Patrick. We will have to talk about the dividend game sometime.
We're talking about a $3,000 investment.
Yeah, it's not bad. But go ahead.
Yes. So again, this is not a particularly high-growing stock, and
but certainly a high-yielding stock, and that's a term that in the financial markets people use quite a bit. They say high-yielding, and that's just a fancy word for a high dividend paying stock. It's really used interchangeably, right? Dividends, yield. It's the same thing, but continue, Patrick.
But here you see the return on equity is kind of low, and then return on assets is even lower. Yeah. And then, with a growth stock, these would be all double digits.
Yeah, yeah. Especially, you would really look at that return on asset, right? And return on equity number would be a big focus. Balance sheet wise. That would be a big focus. PE ratio, though, is decent. And then look at the forward PE there. So you can look at the PE in the past, trailing 12 months. Can you point towards that, Patrick? There. And then you have your forward PE. And you can look at your growth rate. And that growth rate is pretty small.
That's why the price earnings to growth, otherwise known as the PEG ratio, is very, very high here.
Yeah, that is high. Here, you want that to be near 1, don't you? You want to be that near 1, right? For this type of company. But go ahead.
Yes. Yeah. So here you're probably paying too much for growth as it is, and And as you go back to the chart, let me go back.
Did I lose you, Patrick?
Nope, nope.
Okay.
I'm right here.
All right, go ahead.
Go back to the chart. You can see that the stock is, it's not really performed that well because, you're not paying, you're paying a little bit too much for growth. And I think because of its high payout ratio, they're not really investing as much in new technology, new equipment, new infrastructure, new people as a growth stock would.
Yeah. So yeah, this is a good example of a high yielder, not a growth, trading cyclical, meaning sideways, up and down, cyclical. It's up above the 200-day, it's below the 200-day, it's not bouncing off the 200-day and continuing to go up. But in fact, it is just straddling the 200-day.
Yes.
But it's not consistently below. So this is a good example. And what stock are we looking at again here, Patrick?
We're looking at AT&T.
AT&T, a high yielding stock, a dividend, high yielding dividend paying stock. And once you get above, what do you consider high yielding, Patrick? What's a good high yielding dividend? Where's your threshold for high yielding?
I would say anything above 1.5%, because that's the S&P 500.
Okay, so this is super high.
I like to compare things to the S&P 500 because that's a benchmark.
Right.
That, as I described in previous shows, that most, if not all, fund managers can't beat over time.
Exactly. So you look at the S&P, where it's returning. If you can beat the index, just investing in an index fund, if the yield or dividend for that company is better than just simply that, then you're saying that that's the benchmark.
Yes.
Okay. Yeah. I put high yield in a little higher than that. But I think that's a good one. I think that's logical.
Yes.
Yeah. All right. Let's continue.
Okay. We could go briefly talk about Ford.
Yeah. So the Ford Motor Company is an interesting one. Very interesting. So look at this stock that's over the last 5 years has consistently been under the 200-day, and then it shoots way past. Let's talk about that, Patrick.
Yes. So here again, I think because of competition, Ford has kind of underperformed its 200-day moving average. I mean, Toyota's, Nissan, Hyundai, all these and many other competitors are probably biting into its market share, and so you're just seeing the stock just decline because of its business models probably getting kind of old. I mean, here, this is just an anomaly. I mean, every stock kind of suffered here during the pandemic shutdown of COVID from last year. But as you see with this stock is probably turned around because it's investing in more aggressive technology, such as the EV market, the electrical vehicle market. And so that's generating a lot of excitement into the stock.
And yeah, look at this, Patrick. And if you look going way back at the far left, 2016, you can see that Ford literally bounced off the 200-day, the exponential 200-day moving average. So it literally would hit it and bounce off of it. It was, if you were a trader and you saw this stock well below the 200-day, you could buy and just wait for it to get to the 200-day and sell, because it would.
It's going to come back down.
It's going to come back down to 200. The exponential 200-day moving average actually provided what we call resistance, meaning a ceiling that it cannot penetrate. So it's been like that for 5 years. But look at 2021. There's
Yeah,
a couple.
right here.
Yeah, and it started to turn around after the pandemic. I think a few things happened here. So I remember Alan Mulally used to be the CEO of Ford. He actually left Boeing, the Boeing company, to go over to Ford. And so he kind of turned Ford around for a short period of time, and then he retired. Mark Fields took over, but the company still did not perform. It was all over the world. It was trying to have a global footprint. But then after Mark Fields left recently, the new CEO has started to shut down plants where it's not profitable around the world. So Ford is not just necessarily trying to have a global footprint for the sake of losing profits. They're having factories where they're profitable. So they're looking at that more carefully, the income statement, as well as there's a lot of excitement that you were talking about, Patrick, around that new electric F-150 and I think it's the Mark E, that SUV electric vehicle. And then they just recently, I think it was this week or last week, they just introduced another electrical vehicle. So, the market is always looking forward and they pay forward. So there's a lot of forward, multiple PE. People are willing to pay more for the stock based on the direction that Ford is going. So hence you see a breakout above the 200-day moving average, significantly breakout. And some would say it's going to stay above the 200-day. But it's far above the 200 days, made a big run. We have not forgotten that question from Tony. We're going to address that shortly. So, but I believe long term, Ford has turned around. It is now a growth stock and it's not going to come back and stay below its 200-day moving average. It's actually going to continue to stay above, and it would be a safe long-term investment. But what are your thoughts there, Patrick?
Yeah, I think the management shakeup is definitely important. It will probably a more progressive, more forward-looking management. I think the investment in EV is very strategic, and that's because the market is such a buzz in the electronic vehicles. That's adding a lot of excitement to the stock. And three, the streamlining, closing plants where it's no longer profitable. Again, not trying to be all things to all markets, because you're going to get bruised a lot in various markets where you're not very competitive, especially when you're talking about the Japanese and increasingly the Chinese automobile manufacturers. So just stay what you're good at, and then once you accomplish that, then you can go forward. And this is what I think this new management has done.
Yeah, for sure. And I mean, they're investing a lot in the EV space. Electric, they've also made commitments to go full electric, So, yeah,
Yes.
I think they are above. Hey, I have a question from Derek Anthony on the screen. And Derek is asking, being a long-term investor, is there a growth stock that one can invest in over a 5-year period, guaranteeing a return on their investment? And I would say, Derek, there's no guarantees ever.
Absolutely none. Absolutely none.
So that we would never use the word guaranteed here as intelligence investors. But what we would say is that we can lower our probability of failure by using indicators and fundamental analysis to better our chances to get the results that we want, if that makes sense. Would you like to add to that, Patrick?
Yes. Knowledge is king. You have to know the fundamentals of a company or of a sector. I mean, the chip sector, everybody knows, is a growth story, and a good performing company within that chip sector is going to outperform. over a long period of time. But you have to do your homework. You have to do your analysis. You got to look at the chart. You got to look at the fundamentals, and you got to look at the industry in which it's competing in. And if those are strong, then yes, these are going to be great investments over a long period of time.
Yeah, and just to add to that, Patrick, the chips are hot now, like these microprocessors that go into TVs and everything, and they may be hot for the next 20 or 15 years. But at some point, that is going to be replaced by new technology. There'll be something else that's hot, right?
Yeah.
So that's why you have to look at the fundamental analysis to understand, you have these technical indicators to kind of show the efficient market that you referred to, Patrick. But at the end of the day, is it going to continue? Is your company performance, which your stock prices is based on, is your company going to continue to perform? And the only way you know that is, what's happening now is continuing to happen, is continuing to grow as expected or better. It's efficient in the way it utilizes capital and investments and all of that jazz. And its competitors is keeping its competitors at bay. Because, all you need is a great competitor to come in and take market share and everything gets blown up. So there's no guarantees, but certainly, these indicators help with your probability of success a lot.
Yes, indeed.
All right, Patrick, let's go to the next one. I think this may be the last one.
Okay, King Nvidia. All right. So this is certainly a growth stock, to say the least.
Look at that chart. Look at that stock above the exponential 200-day moving average. This is a case, Patrick. If Nvidia touches the 200-day moving average, you should be loading the boat, which is a term for you should be buying like crazy. But go ahead, Patrick.
Well, anyways, to give a little bit of background of this company, Nvidia, which was formed in 1993, it's a company that invented the GPU. Now, what is a GPU? A GPU is a microprocessor dedicated to rendering video graphics. So, in short, that just means that the stronger the video graphics chip, which Nvidia has, maybe not a monopoly, but the most important share of that market. What it does is it gives you a lot of gee whiz effects in gaming. So you're going to see a lot of these in your in your PCs, in Apple products. You're going to see them in your gaming, such as your Sony PlayStations and your Xbox and whatnot. So that's just one aspect of Nvidia, and that's been a very, very strong market. And as of late, that market is so strong that you have weeks, if not months, of delays in getting an Nvidia-based graphics card. I mean, generally, but semiconductors, which this is a producer of, generally semiconductors are in high demand. I mean, because the products there's a huge shortage. I mean, that's always been the case, but right now it's more prevalent. However, with this particular card, this particular company's chips are in such high demand. I mean, even more so than its competitors. You go to a lot of computer stores and you're going to find people camped out.
Yeah, for sure.
Camped out waiting for these graphics cards. And again, that's no guarantee you're going to get a graphics card just because you camp out for 2 weeks or even 30 days.
They cannot meet demand. They cannot. And
they cannot meet demand.
That's what you want. You want a product that everyone loves and they can't meet demand. But go ahead, Patrick.
But that's not the only thing that, you know, its products are used for gaming. There's a huge aspect of Nvidia where its customers are using these cards for crypto mining.
Yes.
There's a particular aspect of the Nvidia graphics card that mines crypto the best. I mean, you could buy, from other competitors, I guess, from AMD and I'm not sure who else is out there, but the Nvidia cards have something very unique about it that makes it very key for crypto mining. So that's particularly important. Another thing about Nvidia, I say it's called King Nvidia, is that it's getting into AI in a huge way. That's where you have all these data centers popping up that are part of this company. The company has also purchased they made a strategic purchase in assisting in that effort in being a key artificial intelligence producer. They acquired a map technology that will enhance its AI capabilities in EVs. So NVIDIA is also in the EV space.
Yeah. And so Patrick,
And I think that's why you had such a recent run up,
well,
and that's really spiked up almost up to 720 a share. And just like a few months ago, it was just like around 500 a share. So you talk about almost 33% growth in this stock.
yeah, well, look at it where it was in 2020. So, I mean,
Yeah, forget about 2000. Yeah, 2020. I mean, it was
go
like
back to
400. Now
January.
it's almost double that.
Yeah, go to January 2020, and yeah, it's at 200.
Yeah, right now you're looking at almost triple.
Yeah, but here's a couple other things, Patrick, because you and I both own Nvidia, and we talk
Yes.
Nvidia quite a bit. Pull the chart down so we can look at the ticker. Yeah, so people can see it. So people who do not regularly follow the technology space may not be familiar with this company. And not only what you just mentioned is a catalyst, but there are a few additional catalysts. One is NVIDIA is in the process of purchasing ARM's holding. And so people who do not follow technology may not be familiar with who ARM's Holdings is. And ARMS is the technology that all of your phones, iPhones, Android phones, all of that, that microprocessing architecture runs off an ARM system. So ARM's chip technology, that protocol is literally in everything. NVIDIA is in the process of purchasing them. So not on top, not just what Patrick just mentioned about all of that other bullish stuff, but they are in the final phases of that. Some believe that, that deal is not going to go through. The government is going to do an antitrust type situation and say, NVIDIA, you're killing the game. It's like putting, the rest of the Brooklyn Nets together with the Lakers and trying to play the rest of the NBA. You're stacking the deck way too much. So
Exactly.
we'll see if that happens. It's 50-50, but NVIDIA is really making that play. The other catalyst that was not mentioned too, Patrick, which we talk about quite a bit, is NVIDIA is about to do a 4-for-1 stock split. And
Yes.
so that price of $713 is going to get divided by 4. Those who are in the stock before a certain date, I can't remember what date that is, Patrick, that whatever. But I know the stock split you were saying is in July. So
Yeah.
if you in
It's a stock dividend.
yes,
Is what it is.
So if you in, and Patrick, maybe we're going live right now, we can't look it up, but if you in NVIDIA before July whatever date, then you would get a 4-for-1 stock split. And so, and the public, they love these stock splits, right? Because the price of the stock itself gets cheaper, but the overall value is the same. But the run up in a split is a big catalyst. So we're really bullish on Nvidia. And then the outlook. Nvidia is not only just doing these graphic processor units and Nvidia shields, which I own, my parents own, and things like that, crypto mining, but they're also in cars now. So they've been working out deals with the chips in the cars. So they're expanding like crazy. And then, Patrick, what about the rating system, the Morningstar on Nvidia?
Well, I know that there's so many strong buys. Like I think there were about, out of the 20 or so analysts out there covering the stock, they are. I think at least half of them have given this thing a strong buy.
Yes. So we're really bullish on Nvidia. So let's wrap it up and let's answer the question that was asked earlier. And
actually, what I would like to do,
go ahead,
real quickly.
Go ahead, Patrick. Apologies.
I just want to show the some of the fundamentals here.
Okay, perfect.
Financial fundamentals. So if you look at this, the performance here.
Can you blow that up a bit for cell phones?
Okay. 1 second.
Yeah, just click in the background. Don't click there. Maybe click in the background, and that might go away. It did not go away. Well, Patrick, you.
Oh, okay. I know. There we go. Let's just have to restart it again. All right, so go price overview right here, and let's say see more.
Yes, and please blow that up a little bit, sir, so I do not get those complaints behind the scenes or text messages. All right, that's better. Okay.
So if you look at the, it's got a high PE. The current PE is around 71, which is very high for stocks. However, if you look at the growth, the price earnings per growth, it's around 3. I mean, you're going to pay a little bit more for growth because there's strong momentum in this.
Look at the forward PE at 40.
The forward PE is dropped down to 40 because the growth is so intensive. If you look at the return on equity.
Patrick, real quick, Patrick, the chip shortage too. Yeah, there's a worldwide chip shortage out there, and these guys, so that could play in there as well, like manufacturing those chips. But go ahead, Patrick.
But you look at the return on equity here, it's like 37, like 38%. That's really high. Return on assets, 22%. Net profit margin. Look at this. That's operating profit margin. Right here.
Patrick, can I pipe in a little bit?
Yes.
So for return on equity and return on assets,
yes.
Here's a benchmark for the public, for our audience. Anything above 15% is good. So it's hard to do on return on equity and return on assets above 15%. If you get above 15% on both of those, you're doing well. So in the 20s, you're doing really well. Return on equity in the 30s is insane. So
yes.
and return on assets is crazy. But go ahead.
And then you can see it's not very highly leveraged. I mean, the debt to equity is very small, like 35 debt to every one of equity. So that's pretty low for such a big, important growth stock. And the market capitalization around $444 billion.
That's not bad. That's not bad. It can easily become $1 trillion company.
Oh, easy, because Apple right now is about a $2 trillion company.
Yeah, and so let's talk about why the market capitalization is so important.
Well, the market capitalization, that tells you how the company is growing, and essentially, if it's a small cap stock, be it a Russell 2000, no more than two billion, or if it's a large cap stock, which would be something that would go into the S&P 500. And
Yeah.
these are the sectors that Nvidia is a part of. So it's part of the Nasdaq QQQs, or the Nasdaq 100. So if you invest in the QQQs, you would participate in the growth of this company. You would, if you're in the S&P 100, you're talking about the 100 biggest companies on the market. That's like the OEX that you would invest in. You would also it's also part of the S&P 500. So you're talking about big cap stock. So essentially, it's a very, very strategic. It's a very well capitalized, but that on top of the impressive growth that it's experiencing, that's why I call it King Nvidia.
Yep. We like Nvidia, and then that just to add to that market cap, for the stock to double, that market cap would double. So you look at that market cap at the top, market capitalization, it's a $44 billion company. So if you think Nvidia is going to double, you'll be betting that $44 billion company is going to become an $800 billion company. And if you believe they can become an $800 billion company, then you believe the stock can double, because that's essentially what's going to happen. So,
yes.
All right, Patrick. So we kind of went through that, and we looked at those are what we called the fundamental. We did a little fundamental analysis. So then let's look at, I have a question from Marvin Jenkins before we go into when to get in. So Mr. Marvin Jenkins, what is Tron case? We're not talking crypto today. Well, we're talking about stocks. We're talking about what's been around for the last 100 and some odd years. Our crypto show would be a different day, and we're doing the show a day early because I have a business trip to Florida tomorrow. So, but thank you for your question in the chat. So, Patrick, we just went through Nvidia. We just in nauseam stated a very bull case, meaning why we will want to buy, why we think you should buy. Now that Nvidia is so far above the 200-day moving average, let's look at it. It's so far above the exponential 200-day moving average. A question came in earlier. Should I buy Nvidia here, or did I miss it? So how will we make that determination? We certainly say long term, we believe it's a buy. But short term, how do you get in? So that's when we start using our other technical indicator. Now that we have determined we have a great growth stock long term that we like, now we're going to look for a pullback for an entry point. So this is when we do our magic. So Patrick, go ahead and show that before we wrap up.
So give me 1 second. I just want to make sure. Okay, I'm maximizing it. Good. Let me go like this. Okay. So anyways, here on the Bollinger Band, you're talking about the upper 2%, the upper 2 deviation. So right now, I think it's quite a bit expensive. I think one should try to wait for a pullback because of this
sorry, Patrick.
Bollinger Band right here.
Patrick, can you pull it into like a 6-month chart or a 9-month chart? You're on a 5-month chart. You're too far out.
6-month chart.
Yeah, so you got to look at it in within 2 quarters, right? So let's look at it here. All right. Continue, sir.
So right now it's pretty much at the upper band of the Bollinger Band or near it. And because of that, even though it's a good growth, long-term growth stock, it might be a little bit expensive. I think this stock, as because it's run up so much so quickly from about 536 to about 713, you're talking about roughly a 30% run in the stock, 30 to 40% run in the stock in such a short period of time. Let me bring this down.
How did your screen go white? I mean black. That's pretty cool. Are
Yeah,
you in
yeah.
a
I'm not
night
sure
mode?
why. I'm
Change the
still
mode.
trying to learn this
I think you
technology here.
click the mode there. I think you're in a night mode, but beside template over to the right.
Okay, mode. Okay,
Yeah, I think you're just in night mode. Yeah,
okay. There we go.
and that
Yeah,
that,
and I
that
apologize for that.
yeah.
But
But
anyway, you're talking around May 17th of this year. It was trading around 536 or so, or 540. Right now it's at 713, in not even a month. And that's like 30% growth from one end of the Bollinger Band to the other. And so ultimately, I think it's got to come back some.
yeah,
And when it does, you might try to see if it could come back at the very minimum to the 20-day moving average within this Bollinger Band envelope. But ideally, you want to get it when the market for the stock is trading around the lower end, because you'll see right here as it traded on the lower end, this has always been a good buying opportunity. Right here again, good buying opportunity. Then ultimately it ran up, and then again another buying opportunity. Then it ran up again. Here, great buying opportunity. It ran up again.
correct.
And it's always stayed above the 200-day moving average.
Correct. So yeah, that's really the point in closing. That's really the point. So to answer to answer the
never
earlier
mind.
question,
Yeah, sorry.
to answer the earlier question,
Yeah.
succinctly.
So never mind this year, because this was the result of the pandemic shutdown. But so this is an anomaly. So you want to ignore this. But however, as I said, every time it's come down to the lower end of the Bollinger Band, that's always represented a good buying opportunity. And we've stated the case fundamentally as to why this is a good stock to own.
Gotcha. Let me take a crack at this too. So
yes.
So even at the pandemic at that low, that's still hitting the bottom of the Bollinger Band. So Nvidia here, just seeing that it's above the exponential 200-day moving average is telling you long term you can buy this stock and it's going to go up over time. There's a good probability, let's say, it's going to go up over time, provided the fundamentals stay in place, right?
Exactly.
So that's a given. The question was, so should I get in now? And the answer to that would be no. Just to be succinct, because it's run too much. It's up at the top of the Bollinger Band. So Patrick, if you can point to the top of the Bollinger Band, right there. So it's near the top of the Bollinger Band. You would not want to buy Nvidia up here. So for the laws of mean reversion, which all stocks behave, all stocks reverts back to its average trading range, its average trading moving average range. And for stocks and other securities, it's 20-day moving average. So it's the middle line in the middle where you see the 640 represented. So in that middle line, the law of mean reversion, the earliest you should buy Nvidia is when the stock retrace back. And Patrick, can you point to the middle, please?
Yeah, the middle right here.
Until you see the stock retrace to that 20-day moving average. And once it retraces back to the 20-day moving average, that would be a point where you could potentially put half or a third of your investment in. So if you had $30,000 or if you had $3,000, you would put 1,000 there, and you would wait to see if Nvidia is going to give you another gift to get down to the bottom of the Bollinger Band, which would be the second deviation low. And then that's when you would load up, because you're getting a second deviation low entry point on a highly growth stock. That's a gift. You will put the remaining of your 2,000, 20,000, or whatever investment you have in. So that's how you would enter that growth stock. But you certainly would not enter when it's near or at the top of the Bollinger Band. And so if you look back in the past, just recently, May 17th, between May 3rd and May 17th, can you point over there, Patrick?
Yes.
That was a gift. That was a good entry point.
Gift.
That was a gift. Go back, Patrick. Go back to, it hit the middle. It hit the middle there. That was another good entry point, because growth stocks, a lot of times, they do not make it to the bottom of the Bollinger Band. They bounce off the 20-day moving average and continue up. So if a stock has a lot of catalysts, mean reversion says it's going to hit the 20-day. It doesn't necessarily mean it's going to get back to the second deviation low. So that was a good entry point. Then go back further, Patrick, to the crash, and right there, that's obviously a good entry point. And just going further back by looking at the 20-day moving average and second deviation low, which is further back in January time. Yeah, that. And then further back in December. So those were good entry points. And you're going to get those entry points again. Just wait. So that's the way I would answer that question. I hope all of that made sense. It looks like that explanation made some sense to Tony. All right, Patrick, I think that was it. Can you unshare the screen? We've had the screen up for a long period of time, and we've been doing a lot of talking. And so,
no problem.
It's good to see our faces again. It's certainly good to see you again.
Thank you.
On a Saturday morning. But that's what we kind of wanted to share today. We wanted to share that and just look at, how do you pick a growth stock? How do you know a stock is a growth stock? Well, any company you're interested in, you put in a ticker. You add a study. It's called a study. You make sure you add the exponential 200-day moving average and not the simple moving average. There's two 200-day moving average. There's a simple version. There's the exponential version. The exponential version smoothens out the big anomalies so that you get a better curve than the simple. So you add that exponential 200-day moving average study to your chart, and then you just look at the stock and see if it's above or below, how it's trading accordingly. Go ahead, Patrick. I know you wanted to chime in.
And it depends on what industry it's in. So I think that's critical, just to understand if it's in an industry that's really going fast, like crypto. Is it in semiconductors? Is it in EVs, electronic vehicles? Or is it in something that's, kind of mundane, like manufacturing or real estate or consumer staples?
Yeah, your consumer staples, whether like your soap companies, your toilet paper companies, your toothpaste, those kind of companies they call consumer staples because you have to buy them regardless, right?
Exactly.
You have to use
whether in a recession or you
have to buy deodorant
times right now.
Yeah, you have to buy deodorant. You have to buy soap. You have to buy toilet paper. Those are consumer staples. That's what we call. But yeah, depending on the sector, and then after you assess a company is a growth company based on its charts, then Patrick did another good thing today. Then he looked at the fundamental analysis, because looking at the exponential 200-day moving average, that's the technical side, right? So then,
Yes.
so that's a product of how the company has been performing in the past. So then you go
Exactly.
look at the fundamentals to say, well, is it going to continue to be that? It
Hmm.
has a good track record. Did management change? Did new competitors join? Are they executing differently, forward looking? And so then once you look at that and say, oh man, it seemed to still have good fundamentals that is in line with the past, then I'm going to put my money here because the company is going to grow, so the stock price is going to grow. And then the last thing that we addressed, Patrick, was, so then when do you get in? So then you look at the Bollinger Band and say, all right, this company is up on the top of the Bollinger Band. That's a bad idea. So wait for the company to get to the middle and put in a small amount there. And if it gets to the second deviation low, the bottom Bollinger Band, load the boat. Load the boat up with the money. Put the
Hmm.
money in the stock. And
In other
just
words, you're going to need a bigger boat.
yeah, exactly. So that was the show for today there, Patrick. I hope everything we said made sense to our audience. And what do you want to say before we wrap it up here today, Patrick?
Yeah. So yeah, just provide. Just give us any questions you have. If you like the show, hit the like button and become a subscriber.
Yeah, ring the bell too so that you get that notification when we go live, like on odd days like today. When and Patrick, we will be in Las Vegas in a couple of weeks.
Exactly.
Yeah, so we'll be in Las Vegas. We'll be shooting the show from there. Patrick already has his hotel. Patrick, can I say your hotel?
Yeah. Okay. I'm staying at the Win.
Yeah, big time
That's what I
guy.
used to stay at.
Yeah, he likes to win. The win is really expensive and nice. I'm staying at the MGM Grand, and then we're gonna look at some real estate there. We'll probably shoot some real estate footage. Patrick's looking at getting another investment property there because the one he's doing, the one he has right now is performing really well. I am considering buying there, and we will be shooting the show from there. But that's 2 weeks from tomorrow. And then we will also get the opportunity to see our friend, Mr. Derek Anthony. He lives in Las Vegas, so we'll be looking
Hmm.
forward to catching up with him. But yeah, sure, I'm looking forward, Patrick, to seeing you face to face and shooting the show live from Las Vegas and looking at some of the real estate you have out there that you think I would be interested in. So that's going to be a good one. Okay.
Yes. Looking forward to that one too.
Let's just wrap up the show. And again, this is the Bet Out of Debt Show. And we call it the Bet Out of Debt Show because when you place a trade, it's called placing a bet. And, placing a bet is kind of a metaphor for investing. And hopefully it's a winning trade that would keep you out of debt. And as always, keep investing. And we will see you next Sunday live here on YouTube. Take care.